The biggest factor holding people back from investing successfully is not making the wrong investments or being unlucky. It's the fear of investing. This fear often stands as a lifelong wall between people and the stock market and in most cases is never overcome. We'll show you how to leave this mindset once and for all. The financial markets are more likely to be perceived as the bad part of the economy, as a place where the rich get rich and poor private investors lose their last penny. As a betting shop where the operator always wins. Let's get to the bottom of these prejudices. You will see, many great opportunities are offered to you through a clearer view of the financial markets. The fears are fueled by the media. Bad news sells better than good or primarily unspectacular news. We prick up our ears when they say, "Warning, this is where you will lose all your money." And that's exactly what we're scared of. We are all terrified of losing our money and ending up empty-handed. The money is at least safe in the account. At least that's what we think. It is precisely because of this fear that most people do not even try to invest their money on their own. In most cases, the maximum investment is a fixed-term deposit account with the local bank, and that is it the only investment. There are some fallacies that perpetuate fear for financial independence. These errors keep the majority of people from truly investing their money profitably. Perhaps you believed this yourself. You will know better after you watch this video. Misconception number 1. You can only win when someone else loses. The decisive factor in our steadily increasing prosperity is economic growth. Our economy has always been growing, and we are constantly developing. You are probably in a beautiful building right now, in front of a laptop or computer screen with a cell phone next to you. Things that 50 years ago people didn't even dare to dream of. It is clear that we are always evolving. The stock market is also developing. The companies that ensure economic growth are the same companies that we can participate in on the stock market by buying shares. The stock market has an upward trend in the long term. The stock exchange prices fall occasionally, but on a long-term average they always grow. So that means there is more gain than loss. It doesn't necessarily mean that someone loses money, because there is just more and more money in circulation. We want to participate in this. Example. Assume that a share starts with a market value of $20. That's the price I buy this stock. It initially drops to $15. But then it rises again, and finally I decide to sell it at $30. Now you buy this stock. This rises rapidly to $50, but drops to $40, where you resell this share. Has anyone lost money now? No. Despite of falling prices, we both made a profit of $10 each. With the purchase of the share, I have acquired the privilege that my money will be used economically by the company. I then resold this privilege to you, and in the end you resold it too. So in this case there is no loser, only participation in companies. A win-win situation. Of course, there are always cases in which you experience a price loss. That's part of the game. However, since the long-term average of the stock market is positive, and we have long-term economic growth, we will also be able to benefit from the stock markets in the long term without someone else having to lose. Misconception number 2. The money is safe in my account. This misconception is based on our convenience. As long as a solution is secure, we don't care. We do not strive for a perhaps much better solution. However, we close our eyes to some important things. First, inflation should be mentioned. The inflation rate shows the increase in the prices of a representative shopping basket. Typically, an inflation rate of 2% is targeted. Yes, we want inflation on purpose, which is the long-term average of price increases. In other words, the value of our money is falling on a long-term average by 2% per year. In about 35 years, the value of money will be halved. If we now have $10,000 in which we do not pay interest, we can buy less of this $10,000 each year. So one thing is certain in the first place, that our money will lose value. I don't know how you think about this, but this isn't security in my book. In addition, your money is only safe as long as your bank still has liquidity. If your bank goes bankrupt, the money is not covered by the statutory deposit insurance and therefore will be lost. So just like with stocks, you're tied to a company's risk. You also have a risk with government bonds. If a state goes bankrupt, your money is gone as well. However, in the form of the banking, the past has shown us that neither scenario is all that unrealistic. So why not choose companies that are possibly much safer than the ones you are currently entrusting your money with? Misconception number 3. The stock exchange is nothing else than a casino. This misconception is based on misconception number 1. Since the prevailing opinion is that the amount of money remains the same on the stock exchange and that the money is only in other hands, the stock exchange is often referred to as a casino. Profits should only be possible through luck, as the amount of money does not increase. You can't see through the confused financial system anyway. So it is more or less coincidence or luck who gets the money. For some, the stock market is certainly a casino. People who speculate on short notice or try their hand at high-risk financial products may feel that way. As soon as people buy without a plan and without a good reason, it really is a gamble whether the stock is good or bad. Anyone who lets their financial advisor sell something to the bank is making the same bet. It is pure coincidence whether you hit a hit or a rivet. However, once you start looking at your investments, the stock exchange is not a casino. There is no such thing as a casino operator, who always has to win in the long run in order to finance his business. The stock market has an upward trend. We always have long-term economic growth. As a result of this growth, there is on average more money to be gained than to lose on the stock market. Misconception number 4. There is a high probability of losing your money on the stock market. As already discussed in misconception number 2, the risk of uninterested money and the money that was believed to be safe in the checking account isn't safe at all. At the beginning I mentioned that people have a huge fear of losing money. Understandable when today almost everything revolves around money. There is definitely always a risk. But there is no form of investment in the world that is risk-free. As a rule, the following applies: higher risk equals higher return. Greek government bonds bring higher interest rates than German government bonds, as the risk there is much higher. However, we can determine our own risk. And we can minimize the risk. There are various tools that the financial markets offer us. The diversification of the share portfolio is very important. This means that there's no focus on one share or bond, but several. Diversification is possible through mixed financial products. We can buy stocks, bonds and commodity certificates to further reduce our risk. The total loss of the capital can thus be as good as excluded. The other point, of course, is sufficient knowledge. Knowing what you are doing reduces the risk of buying riskier company stocks or bonds. You can learn to trade stocks like any other discipline, and I want to help you with that. You can also consciously choose companies such as Coca-Cola, McDonald's or Microsoft, where bankruptcy is almost impossible and still benefit from rising prices or dividend payments. Misconception number 5. Only banks and the super rich can benefit from the stock market. Often, a failure to invest is justified by the belief that only the big players within the financial sector can benefit from the financial markets, whether it is because of inside information or certain secret formulas. We have already shown you that on the stock exchange prices tend to rise and not run horizontally. Misconception number 1. Of course, it is possible that the rich have advantages in terms of information. However, this in no way affects the fact that you can still invest profitably too. The profits of the best fund managers have no direct negative impact on our investment and our personal returns. Nowadays, we have almost all relevant information about every relevant stock. Warren Buffett, for example, still invests without a computer and only focuses on a few metrics. So you don't need all the information that the big names in the industry have. Finally, I hope you see that these 5 misconceptions, and take away your fear of the stock market. For the most part, the fear is unfounded. It is this channel's goal to show you how easy investing is and that everybody should at least try it.